Hey everyone, welcome back to Corporate Decoder, the place where we take financial documents and make them not nearly as boring as they sound. Today we're unearthing secrets from an amendment to Medtronic's annual report, and trust me, there is a little more to this than just a paperwork fix. Alright, so what we have here is an amendment to their earlier report. Think of it like noticing you forgot to add a crucial footnote to your essay right before it is due. They filed their main annual report back in October 2025. Covering their year up to the 30th of April 2025. But guess what? They missed adding something super important called IXBRL data tagging. This is basically a way to make financial data more understandable by computers, and they accidentally left it out. So this amendment is purely to add that missing digital labeling, meaning the actual financial story hasn't changed from the original filing. We're going to dive into the numbers that were already there. Looking at how Medtronic's savings and investment plan was doing, this filing is all about the Medtronic savings and investment plan, which is a pretty fancy name for what amounts to a 400 type plan for their employees. It helps people save for retirement. First off, we've got the stamp of approval from the auditors PricewaterhouseCoopers LLP. They've looked everything over and say the financial statements are, quote, free of material misstatement. That is good news, meaning nothing major seems to be hiding or wrong. They've been auditing this plan since 2023. Which gives them a good understanding of its ins and outs. Now, onto the juicy part, the money. We're looking at the net assets available for benefits. This is basically the total amount of money in the employee's retirement accounts. As of the 30th of April 2025, the total pot was just over $13.7 billion. That's a huge amount of money. Now compare that to the 30th of April 2024, it was about $12.9 billion. So in 1 year, the plan grew by a solid $800 million. That's a pretty nice jump, showing the plan is growing and likely thanks to good investment performance or steady contributions. The vast majority of this money, nearly all of it, is tied up in something called the Medtronic Inc. Master Trust Fund. This means all the employee money and company contributions are pooled together into one big investment fund managed by the company. The total value here in 2025 was $13.4 billion, up from $12.6 billion the year before. This fund is where the real action happens, where the money grows or shrinks based on market performance. We also see employer contributions listed under receivables, which was $212 million in 2025 and $219 million in 2024. This is money the company owes to the plan but hasn't fully deposited yet. It is a relatively small amount compared to the total fund value, and it stayed pretty steady year over year. Then there are notes receivable from participants. This is essentially money employees have borrowed from their own retirement accounts. In 2025, this amount was about $98 million, up from $95 million the year before. So a bit more employees are tapping into their savings. While it is good that the plan allows for this flexibility, a high number here can sometimes be a sign that employees are feeling a bit squeezed financially. Looking at how the money came in and went out for the year ending the 30th of April. 2025, the plan saw total additions of over $2 billion. That's a massive influx of cash. A big chunk of that, $1.155 billion, came from the income generated within the Master Trust Fund itself. This is the investment growth, the dividends, the interest, the whole lot. This shows the investments are performing well, bringing in significant returns. Employees themselves contributed $508 million. That's a healthy amount, showing people are actively saving. And the company chipped in with $346 million in employer contributions. That is a significant contribution from Medtronic, showing good support for their employees' retirement. So, with income and all the contributions, the plan added over $2 billion during the year. On the flip side, benefits paid out to employees, meaning people retiring or withdrawing money, was $1.29 billion. This is a substantial outflow as expected for a large retirement plan. Even with those big payouts, the plan saw a net increase of $787 million for the year. This confirms that the money coming in, primarily from investments and contributions, was greater than the money going out. Now, let's zoom in on the nitty-gritty of what makes this plan tick. It is actually a layered plan with four main parts. There is the core 401 component, which is where employees can put pre-tax or Roth dollars from their salary, and Medtronic matches a good chunk of it. They actually automatically enroll new hires at 6% unless they say otherwise, which is a smart move to get more people saving. They even have an annual increase of 1% until you hit 10% in contributions, which is a really good incentive to keep saving more over time. Then there is the Employee Stock Ownership Plan, or ESOP. This is where they used to put matching contributions and even some direct company stock. It is interesting because it also includes matching from the 401 component, and they talk about this ESOP holding company stock. We'll see how much that is later. Next is the Personal Investment Account, or PIA, for those who joined before 2016. It's for additional employer contributions like a bonus retirement savings boost. And finally, the Medtronic Core Contribution, or MCC, for folks hired on or after the 1st of January 2016 or certain rehired employees. This is another way the company adds money to retirement accounts. The employer match is pretty generous. Medtronic matches 50% of what employees contribute, up to 6% of their salary, plus trees a true-up contribution at the end of the year where they might add even more based on company performance. In 2025, this true-up was 17.3% of eligible compensation. Capped at 6%, that's a really significant bonus if the company does well. The ESOP part has a history. Before May 2005, employees got matching contributions and annual employer contributions in company stock. They can still diversify these accounts, but it shows a long-standing connection to employee ownership. The PR contributions for the year were about $38.6 million, and the MCC contributions were a bit higher, around $107 million. These employer contributions are a direct benefit to employees and a sign of strong company support for retirement savings. When it comes to who owns what, employees are 100% vested in their own contributions instantly. For company contributions, it's a bit different. Generally, you need 3 years of service, but for those hired before 2016, it is a faster cliff vesting at 20% per year, fully vested after 3 years. You also become fully vested upon reaching age 62. Or if the plan is terminated, or if the company stops contributing. What is interesting is that when employees leave before being fully vested, their non-vested balances are forfeited. These forfeited amounts then get used by the plan to either reduce future employer contributions or cover administrative costs. In 2025, about $9.5 million of these non-vested accounts were used to reduce employer contributions and about $370,000 for administrative expenses. This practice helps the company save money and effectively reduces the cost of the plan over time. Let's talk more about those loans. Employees can take out up to 50% of their vested account balance, not exceeding $50,000. They can have 2 loans at once, one for general purposes and one for a primary residence. These loans are typically paid back over 1 to 5 years for general needs and up to 15 years for a home loan. The interest rates are pretty reasonable, currently ranging from 3.25% to 9.50%. Now we get to how everything is valued. For most investments, they're valued at fair value, meaning what they're worth on the open market. But for certain investments, specifically fully benefit, responsive investment contracts within the Medtronic Capital Preservation Fund, they're reported at contract value. This contract value is what participants would get if they withdrew their money. The accounting world breaks these fair values down into levels. Level 1 investments are things like stocks traded on major exchanges, valued using readily available quoted prices. Medtronic PLC ordinary shares and their ESOP holdings, for example, are level 1. Level 2 involves investments where you might not have exact quotes for identical assets, but have similar ones or observable data like interest rates. Level 3 is for the trickiest ones, where the value relies heavily on unobservable inputs and management's own estimates. In 2025, the plan had over $11.9 billion in collective trusts measured at net asset value, or NAV, as a practical way to estimate fair value. These are essentially funds of funds, pooling money to invest in a variety of stocks and bonds. The Medtronic PLC Stock Fund and ESOP Fund, which is mostly company stock, was valued at about $441 million in 2025. The self-directed brokerage account, where employees can pick more individual investments, had $779 million in value. And then there were registered investment companies, which we usually think of as mutual funds, valued at $43.9 million. The Medtronic Capital Preservation Fund, which holds those fully benefit responsive investment contracts, was valued at $510 million in 2025. These contracts are special because they guarantee the principal and a set interest rate, making them very stable. This whole master trust structure is pretty important. It combines the assets of this plan with the Medtronic Puerto Rico Employees Savings and Investment Plan. This pooling allows for economies of scale and potentially better investment management. Looking at the plan's specific slice of this trust in 2025, its share was worth over $13.3 billion. This is up from $12.6 billion in 2024. The biggest component here remains the collective trusts, making up over $11.6 billion of the plan's interest. The entire master trust itself is worth about $13.7 billion. So, this employee plan holds the vast majority of the Master Trust's assets. The income generated in the Master Trust for the operations of this plan was a substantial $1.155 billion for the year. This income is mostly due to net appreciation in fair value of investments, which was over $1.17 billion. This is the pure investment gain. Here we see some transactions that involve parties related to Medtronic. For example, the Master Trust buys and sells Medtronic PLC ordinary shares. In 2025, they bought $12 million and sold $65 million worth of company stock. This is typical for an ESOP component where company stock is held. Also, the loans to participants are considered party-in-interest transactions. These are allowed as long as they are properly structured to be exempt from prohibitions on transactions between the plan and insiders. Good news on the tax front. The plan has a favorable determination letter from the IRS, meaning it is designed to be tax exempt. This is crucial for a retirement plan, as it allows the investments to grow without being taxed year after year. They believe they're operating in compliance, so no taxes are being paid from the plan itself. This section bridges the gap between how the financial statements are presented and what is reported on the Form 5500, which is another government filing for employee benefit plans. For the most part, they reconcile very closely. The net assets available for benefits on the financial statements were about $13.72 billion in 2025. And on Form 5500, it was $13.719 billion. The small difference is mainly due to how deemed loans that are considered distributions, because they haven't been paid back or handled. And finally, subsequent events. This section tells us about anything significant that happened after the reporting period, but before the report was officially issued. In this case, they've evaluated events through the 20th of October 2025 and state there have been no significant subsequent events to report. That means everything was pretty quiet after the 30th of April 2025. In terms of major developments, let's look at the specific assets held. The schedule of assets at the 30th of April 2025 confirms that the plan's interest in Medtronic Inc. Master Trust Fund is the overwhelming majority of assets valued at $13.4 billion. Then you have the notes receivable from participants at about $97.4 million. This is essentially a loan portfolio from employees. The cost column is marked with an asterisk, meaning it is excluded because these are participant-directed investments. So the cost basis isn't as relevant as the current market value. So what is the story here? Medtronic's employee savings plan is in robust shape. The plan's value grew by nearly $800 million in a year, primarily driven by strong investment performance within their pooled master trust. Employee and employer contributions are significant, and the company even offers generous matching and additional contributions like the PR and MEGC, showing a real commitment to their employees' long-term financial well-being. The plan is well diversified, although a portion is invested in company stock, which is common for ESOPs. The fact that they've corrected an omission of IXBRL tagging shows they're serious about transparency even for the digital side of reporting. The absence of significant subsequent events suggests a stable period following their fiscal year. And overall, this report paints a picture of a healthy and capably managed retirement plan, benefiting both Medtronic and its employees. What do you think about this retirement plan's performance and structure? Does Medtronic's approach to employee savings make you optimistic about their company culture? Let us know your thoughts in the comments below. If you found this breakdown insightful, please hit that like button and subscribe for more exclusive dives into corporate filings. Don't forget to join our Discord community linked in the description for even more discussions and insights. Thanks for watching, and we'll see you in the next episode of Corporate Decoder.